Set up for retail traders. They get excited, they place their entry at the breakout. Set their stop loss just below the level, and mark their targets higher, expecting the trend to continue. But watch what happens next. Right after the breakout, the market prints a strong, bearish candle that completely engulfs the bullish breakout candle. This is your bearish engulfing bar, and it's not just a reversal pattern. It's a liquidity sweep engineered by institutions. They know exactly where breakout traders will enter. They know where the stop losses are hiding. So they let the market break the level, trap delayed buyers, and then slam price back down, stopping out retail traders in seconds. From there, the market reverses hard in the opposite direction, leaving retail traders on the wrong side, and smart money riding the move they planned all along. The silent flip is a smart money reversal pattern that forms at the end of a downtrend, but unlike flashy breakouts, it signals a shift quietly, just before the real move begins. This pattern tells you one thing: the trend is about to flip, and smart money is already preparing. The silent flip is made up of 3 candles, and when it forms at the right location, especially after a liquidity sweep, it becomes a powerful entry trigger. Here's how to spot it. The market must be in a downtrend, or the move leading up to the pattern should be clearly bearish. The first candle in the pattern is a strong, bearish candle showing clear selling pressure. Retail traders are fully convinced the downtrend will continue. The second candle has a small body with a long, lower wick. This candle triggers limit buy orders. It's where smart money quietly steps in, absorbing sell-side pressure without revealing their hand. The third candle is strong and bullish. It closes well into the body of the first bearish candle, ideally above its midpoint. This candle confirms that the flip in sentiment has happened. Buyers are taking over. The silent accumulation is now turning into an explosive move. Now let's look at a real chart example. This is the Australian dollar against the Canadian dollar. On the 15-minute chart, the market was clearly trending down. Sellers were in full control. Then price hits this level and gets rejected hard, forming a temporary support. Now watch closely. Price pulls back, and this time it breaks below the support. At that moment, retail traders are fully convinced that's the breakout. The market's going lower. They start placing sell entries at the close of the candle that broke the support. Others get more aggressive, placing limit sell orders just below the breakout candle, and almost all of them hide their stop losses just above it. But what happens next is where smart money shows up. Suddenly a bullish candle forms. Then another even stronger bullish candle follows. That's the silent flip in action. 3 candles, 1 engineer trap. Smart money first breaks the level to trigger retail entries, then pushes price back up to trigger the limit orders, and finally uses the third candle to hit the stop losses. And just like that, retail traders are trapped. The move they thought was a breakout was just a setup for the real reversal. From there, the market flips direction and starts trending upward, leaving smart money in control, and retail traders stopped out and confused. Look at another chart. This is the New Zealand dollar against the US dollar. On the 15-minute time frame, the market was clearly moving down until it hits this level aggressively and reverses, leaving behind a clean demand zone. Then price pulls back again and reaches the zone. And this is where the silent flip candlestick pattern appears. Let's break it down. The first candle confirms that bearish momentum is still present. It also triggers limit buy orders from traders who are betting on the demand zone to hold. The second candle dives deeper, breaking below the zone. This move is designed to trigger stop losses sitting just below the area. And then comes the third candle, a strong bullish candle that confirms the momentum flip. This is the silent flip, a smart money move designed to fake out retail traders, sweep liquidity, and reverse the market with precision. Once you spot this formation, the entry is simple. Enter at the close of the third candle. Place your stop loss below the second candle and target the next resistance level. Now look at what happened next. As expected, the market reversed and pushed up strongly because smart money had already cleared the path and flipped direction. The silent drop is a smart money candlestick formation that signals a potential bearish reversal. It's designed to catch breakout traders off guard, especially after a strong move up. The pattern is made up of 3 candles, and together they tell the story of a shift in control. From buyers to sellers, here's how it forms. The first candle is a large, bullish candle that confirms buyers are still in control. This candle usually breaks above a previous high or continues the trend with momentum. The second candle is bearish, with a small body and a long upper wick. It shows that buy stop orders from breakout traders and buy limit orders from late buyers are getting triggered at the same time. Stop loss orders of early sellers, those who place sell limit orders at resistance, are also being swept. Third candle is a strong, bearish candle that completely shifts momentum. It often engulfs the second candle, and in many cases, closes deep into the body of the first candle, confirming that buyers are trapped and the reversal has begun. This isn't just a visual pattern, it's a liquidity trap wrapped in a 3-candle sequence. It's the moment where smart money sells into strength, sweeps the last round of retail buy orders, and then drops the market hard. Once you understand the silent drop, you'll never look at the top of a trend the same way. Again, look at this chart. The market pushes up, hits this level, and pulls back, forming a clear resistance zone. Then price goes up again and taps that same level. But this time something different happens. The silent drop pattern forms. Here's how it plays out. The first candle touches the resistance and immediately triggers sell limit orders from traders expecting the market to reverse again. At that level, the second candle pushes higher, just enough to take out their stop losses. This is the liquidity sweep smart money was waiting